Good morning, students. Welcome you all once again in the third lecture and in the third lecture of financial reporting and second lecture and the last lecture of Indian Accounting Standard 1 presentation of financial statement. I believe I am audible and my screen is also visible to everyone. Am I audible and my screen is visible? Okay. Yeah. Students, in the last class, we have started discussion on Indian Accounting Standard 1 presentation of financial statement. And at that point of time, we have discussed that what is the agenda of this standard. Then we talked about objective of Ind AS 1. We discussed the scope of the standard. We discussed the definition of general purpose financial statement, the meaning of Indian accounting standard and where it was notified, the meaning of materiality, right? Then we have also discussed about the purpose of the financial statement, and we have discussed in detail about the component or complete set of financial statement where we have talked about the third balance sheet concept in detail. And you remember, I have shown you the balance sheet or annual report of ONGC Limited. You remember that? Okay. Then, friends, we have discussed the general features or overall considerations while preparing or auditing the financial statement. Right. What could be the general features or overall consideration? It's like a fundamental kind of accounting assumption. So it is a presentation of true and fair view in compliance with all Ind AS. There is a para 16, para 16, which says that the entity has to give an explicit and unreserved statement of compliance with all Ind AS. And I have shown you that statement of compliance in the ONGC annual report, right? This was a new requirement. This requirement was not there in our old accounting standard or Indian GAAP, right? This requirement is there in Ind AS 1. Then we discussed about the concept of going concern, that what is the meaning of going concern, and when an entity is not required to prepare the accounts on a going concern. Otherwise, going concern is again kind of a fundamental accounting assumption. An entity is required to prepare its accounts on a going concern until and unless some condition prevails that the assumption of going concern is not right. For example, if an entity wants to stop its business, wants to liquidate its business, or the entity has already started, ceasing the trading. For example, there is a big company and the company has a presence in all over India, and the company has started cutting down its operations, right? Sooner and gradually. So they have already stopped the operation in North India. Now they are moving to the South India for stopping their operation or ceasing their operations. So the company has already started ceasing their operations, right? Or there is no other alternative except to do so. Okay. Then we discussed about the material uncertainty in relation to the going concern. And I have also talked about the annual report of Vodafone Idea Limited, where the Vodafone Idea Limited has also disclosed the uncertainty with respect to the going concern. Then we discussed the concept of accrual basis. Then we discussed the concept of not aggregation and materiality, rather we discussed the concept of consistency. So we discussed the concept of consistency. Now we'll discuss the concept of aggregation and materiality. What is meant by aggregation and materiality? Friends, if you have seen the balance sheet, right? In the balance sheet of any company, any big company like Reliance, Adani Enterprises, Bharti Airtel, any big company, the balance sheet is only one page balance sheet or maximum two-page balance sheet, right? But if you look into the background of this balance sheet, when I say background means this balance sheet, how this balance sheet was prepared. There was a transaction which was happening on the ground. There was journal entries. Then journal entries take the shape of your ledger account. Then ledger take the shape of trial balance. Then from the trial balance, financial statements will be prepared. And from the trial balance, those GL accounts, those GL codes have been merged into the groupings, and then grouping, the balance sheet captions, the P&L captions will emerge, right? This is how your financial statements are getting prepared. Now, friends, if I talk about a company, for example, Bharti Airtel Limited. So Bharti Airtel Limited has around, 35 crore subscribers. 35 crore subscribers means they have 35 crores customers. It means they are raising bills to the customer in a quantum of 35 crore. So every month Bharti Airtel is raising invoice to 35 crore customers. What is the total which is coming out at the end of the year? The total outcome for the year, the total invoice is 420 crores roughly. So if I'll aggregate this entire total, if I aggregate the amount which is coming out from 420 crore invoices, the total comes out, let's say, 1 lakh crore. 1 lakh crore. So you will find this 1 lakh crore in a single line item, revenue from operations. 1 lakh crores, right? It will be 1 lakh, and rupees in crores is the rounding off. Now the point is, this entire big volume has been just disclosed in a single line item in the P&L, revenue from operations. That's all, right? So why Bharti has done this like this? Why Reliance is aggregating all its transaction, all its similar transaction, and showing in only one caption? So what is the accounting assumption? What is the general features which allows Bharti Airtel, which allows Reliance to do so? What is that consideration? Can anyone tell me what is that consideration? Bindu, Abrakesh, what is that consideration? Yes. Rakesh is saying, sir, it's aggregation concept. You are right. Aggregation concept. In our accounting standard in Ind AS 1, there is a concept of aggregation. And it says that all like item needs to be aggregated. All like item needs to be aggregated. So friends, that is why the entire revenue doesn't matter whether 1 crore, 1 million, 1 lakh invoices has been raised to 100 crore of customer, doesn't matter. End of the it is a revenue. End of the it is the top line of a company. These all are the like item. Bharti Airtel is providing the telecom services to all these 35 crore customers, right? So this entire revenue from every customer has to be aggregated and shown as a revenue from operation. This is the concept of aggregation. I hope it is clear to everyone. Now, sir, what is the concept of materiality? Right? Now, the concept of materiality says that, all the material item needs to be presented separately. All the material item needs to be presented separately. For example, you have seen in many clients, in many companies, there is a concept or there is an item of, profit on sale of fixed assets or loss on sale of fixed assets, right? Let's say the company has a very minuscule amount of, profit on sale of fixed assets. So the company has sold some scrap. The company has sold its old chair, table, furnitures, old computer and laptops. And probably the company has ended up bearing a loss of, let's say, 1 lakh rupees. And it is a minuscule amount for the company. The company is rounding off its numbers in millions or lakhs, right? So friends, first of all, this profit on sale of fixed assets or loss on sale of fixed assets being a very immaterial amount, the company can club with other expenses, right? The company does not need to call out the separate line item as a profit or loss on sale of fixed assets. But at the same time, the company has a material amount of profit or loss on sale of fixed assets. And the company business is not to sell the fixed asset. Had the company's business is to sell the chair and table and computer and laptop, whether it will be called out as a fixed asset? Students, what's your view? I am saying that I am saying that the business of the company is to sell the fixed asset. So whether those items will be called as a fixed asset, those items will become the inventory. You are right. Those items become inventory. For example, Maruti Suzuki India Limited is selling cars. And cars are fixed asset for me, for Abhishek, for Abrikesh, for Bindu, for Rakesh, for Dhara. But for Maruti, those cars are inventory, right? So, friend, if a company has sold a big amount of, fixed asset, for example, the company has sold one of its plant, right? And there was a material amount of profit or loss on sale of fixed asset. So it has to be presented separately. It has to be presented separately, right? As a separate line item so that user will be able to understand, oh, in this particular year, due to this event, there is a huge impact on the bottom line of the company. There is a huge impact on the P&L of the company, right? On the performance of the company. So friends, standard says that all like item, all similar item has to be aggregated and shown as a one item. All material item needs to be presented separately. All immaterial item has to be aggregated with the other item. For example, the company has spent a small amount on printing and stationery. If you will see the schedule of other expenses, right, you will find a caption of others in other expenses or miscellaneous expenses in other expenses, right? So if you are running a company in the day-to-day affairs, you will have lot of expenses. You will have printing and stationery expenses, books and periodical expenses. You will have conveyance expenses. You will have, staff lunch expenses. You could have some gifts expenses, right? So there could be a lot of expenses. Okay. Now the question is whether those expenses, every expense has to be shown separately. If you started showing the every expenses as a separate line item in the other expenses notes to accounts, in the other expenses schedule, probably it will be running into the pages, right? And friends, you know, over disclosure of information, over disclosure of information does not always help the investors or user of the financial statement. Over disclosure of the information sometime distract or digress the ability of using those financial statement or ability of reading those financial statement, right? As you are aware, on the date of examination, you all are preparing for the examination, and now we are covering this Ind AS 1 into 8 hours, or sorry, 6 hours, right? But will you spend 6 hour time just a day or 2 days before the examination? Answer is no. You will just note down the pointers, these pointers. You will just go through with just this one single page. Oh, these are the overall considerations: true and fair view, going concern, accrual basis, aggregation in materiality, offsetting, frequency of reporting, comparative information, consistency. You are just going through with the pointers, right? And that's how, the user also need some crisp, some summarized information so that user will be able to process in their mind and understand those financial statements, right? I hope it is clear to everyone. I hope it is clear to everyone. Now the next concept is offsetting. Now, what is this offsetting? For example, let's say I am, for example, Bindu. Yes, Bindu is my client. Bindu is my customer, and I'm teaching Bindu financial reporting. She is paying me coaching fees. Okay, and Bindu is also, into the business of selling furniture. So Bindu has a furniture shop. I am teaching Bindu and I am charging fees from Bindu. She is paying me tuition fee every month. At the same time, I am also purchasing furniture from Bindu, chair, tables, etc., etc. Now, in my financial statement, in my business, Bindu is my customer as well as Bindu is my creditor, supplier. Okay. So Bindu is a debtor for me and Bindu is a creditor for me at the same time. Okay. Now the question is, let's say at the end of the year, I have to pay 50,000 rupees to Bindu for the furniture which I have purchased on a credit basis. At the same time, at the end of the year, Bindu has to pay me 20,000 rupees for my tuition services, let's say. And normally what happens, of course, I am giving her goods and services, she is giving me goods and services. So whatever is the position we are settling in the net, it's not like that I'll pay her 50,000 rupees, then she will pay me 20,000 rupees. So not like that, right? Now from the P&L perspective, I understand that, whatever I am supplying as a goods or services, that is an income revenue for me. Whatever I'm purchasing from Bindu, it's a fixed asset for me, and I'm charging depreciation in the P&L. But as far as the payable and receivables are concerned, right? The payables and receivables are concerned, whatever is the net position at the end of the reporting period, that net position has to be either payable or either has to be receivable, the net position, right? Now the question is whether this debtor and creditor has to be shown separately, since it is from the same party, whether it has to be shown separately or it can be netted off. What do you think? What should reflect the right picture? And just think about logically. For example, if I have to pay 50,000 rupees to Bindu and I have to receive 20,000 rupees from Bindu, it means out of 50,000 rupees, I have already paid 20,000 rupees to her in the form of my services, right? So I have a contractual obligation to pay 50,000, not 50,000 rupees. I have a contractual obligation, or I am obliged to pay 30,000 rupees only, right? So in this case, I can net it off. You're right, Dhara, I can net it off. I can offset my trade receivable and trade payable. At the same time, whatever Bindu is providing me in terms of goods and services, which is furniture, and we have a contract that, the amount which I have to pay to Bindu, it has to be secured because I have given her a bank guarantee, right? If I'll not pay, she will revoke that amount. She will revoke the bank guarantee. But whatever I have to receive from her, it is unsecured. So my payable is secured, but my receivable is unsecured. Can I offset this? For example, today, if I will not be in a position to pay, Bindu will revoke my bank guarantee and she will realize it's her money. But tomorrow, if she will not be able to pay, I can't do anything except chasing and following up with her, right? So one part is secured and one part is unsecured. The payable is secured and receivable is unsecured. Can I net it off? Answer is no, because it will not reflect the right picture to the user of the financial statement, right? As one is secured and another one is unsecured. Okay, is that clear? Okay, friend, this is how the concept of offsetting is there. It says that assets and liabilities, income and expenses shall not be offsetted unless required or permitted by Ind AS. So it is a negative kind of a statement. When act are constructed or act are drafted, so act are very peculiar one. They are very, difficult to read. So that is why the services of we chartered accountants or lawyers are required. So in terms of offsetting, the standard says that assets or and liabilities or income and expense can be offsetted if it is permitted by Ind AS. As simple as, right? If it is permitted by Ind AS. For example, Ind AS says that, Ind AS 37, it says that if you are giving a warranty to your customer and you are also getting a warranty from the manufacturer, right? In the P&L, whatever warranty expenses you have to incur, right? And whatever reimbursement you are required to be received from your manufacturer, in the P&L, Ind AS 37 says that in the P&L you can net it off, you can set it off. But in the balance sheet, you cannot offset. Why? Because the warranty which you are required to provide, it is to the different set of customers, different set of people. And the amount which you are have to receive, it is from the different parties. So parties are different. You cannot offset. You cannot offset. For example, I purchased a mobile phone, okay? And I went to the shop because my mobile phone was under warranty. I went there and I said, this mobile phone is no more working, is not working. So it was under warranty, and the supplier or the shopkeeper has to spend 10,000 rupees on its repair and maintenance. Now the shopkeeper has to get reimbursement of 10,000 rupees from the manufacturer. Now what happened? So in the P&L, of course, whatever I am incurring, I'll receive from the manufacturers. So Ind AS 37 says that you can offset, you can net it off, this expenses and reimbursement. You can show it zero. Or if you want to show it gross, you can also show it. It gives you both the presentation. But in the balance sheet, it says that you cannot offset. Why? Do you remember in my example with Bindu, I am dealing with the same party as a payable and receivable. But in this case, your warranty obligation is to with the customer, whereas your reimbursement of money is from the manufacturer. So parties are different. And Ind AS 37 hence says that you cannot offset in balance sheet, but you can offset in P&L. Right? Now, sir, at many times we are showing, you know, debtors less provision for doubtful debt. Debtors less provision for doubtful debt. Have you seen in the balance sheet, in the notes to accounts? Trade receivable less provision for doubtful debt. Net number is coming into the balance sheet. Is it a offsetting? It is not a offsetting. Standard says that if you are measuring assets net of valuation allowances, you have a right to receive 100 crore rupees from your debtors, and you think and believe that probably 10 crore amount will become bad. I will not be able to recover 10 crore rupees. So you, in your books of accounts on a conservative basis, is providing a provision, is providing a provision, right? You are on a conservative basis, right? So it is not like that you are losing your right to receive. You are chasing and following up with the customers, right? You are asking for entire 100 crore rupees. You are not saying that I'll not receive this money. You are not saying that I'll not receive this money, right? So just in your books of accounts on a conservative basis, when you are measuring this asset, you find that the value of this asset is not 100 crore, probably it is 90 crore as of now. And that is why you are creating a valuation allowance. Okay. Standard says that measuring an asset net of valuation allowance is not considered as a offsetting, right? For example, obsolescence allowance on inventory, doubtful debt allowance on receivable. This is not considered as a offsetting, right? Is that clear, friends? Any doubt here? If there is any doubt, you can just write down your doubt either on the query link of ICAI or on the chat box, which is there on the Zoom. Sudhara, Chandra, Chandan, Abrakesh, Bindu, Priyanshi, Rakesh. Clear? Let's move to the next part, comparative information. And friends, you have seen that whenever you prepare your financial statement, there should be a comparative information with respect to your numbers, right? And with respect to your descriptive information, right? So I can just show you, I'm just opening one of the balance sheet, which is, just allow me a minute. Yes. This is Hindustan Aeronautics Limited balance sheet, and you can see, first of all, you can see, I hope this balance sheet is visible to everyone. Hindustan Aeronautics Limited. Yeah. You can see they have given the comparative in balance sheet, right? Although the third year comparative is also there, but this third year comparative is there because this company has retrospectively restated its financial statement. Why? Because of correction of error. You remember in the last class, I have you know talked about the third balance sheet concept, right? This comparative is given in the balance sheet. The comparative is there in the P&L. It's a balance sheet. Then there is a comparative in P&L. Then there will be a comparative in the statement of changes in equity, right? There will be a comparative in the cash flow statement. You can see everywhere there is a comparative. Then accounting policies are there. When we go to the notes to accounts, we will find the comparative everywhere, right? You can see, you can find comparative everywhere, right? In the notes to accounts. And even where you are providing descriptive information, you will find the comparative there as well. Let me show you. You can see the total is 2500, previous year, previous year. So wherever they will talk about the descriptive information, which includes number, they will also give the number for the previous year, right? So comparative information is required at least for 1 year, at least for 1 year. Okay. Then the next aspect is, sir, comparative is required for at least 1 year. Okay. If the company will reclassify the comparative, then, for example, earlier the company was, clubbing this printing and stationery into other expenses as a others miscellaneous expenses. But now the company has spent a huge amount on printing and stationery, and the company is disclosing this line item separately. In that case, of course, the comparative number, just for showing apple to apple, the comparative number is also required to be restated, reclassified, right? In that case, standard says that whenever the entity will reclassify the comparative amount, the entity has to provide the nature of the reclassification, amount of each item of the reclassification, and the reason for the reclassification, right? And if the company would not be able to reclassify the comparative amount, in that case, the company has shown, printing and stationery separately for the current year, but last year amount the company is not able to identify, and now the last year it has to show zero. In that case, the company has to provide the reason for not doing the reclassification, right? So friends, this was the concept of overall consideration while preparing a financial statement. You have to be mindful and meaningful about some features. What are the features? You have to give a statement of compliance. Your financial statement should reflect true and fair view. And true and fair view will be achieved by complying with all the Indian accounting standards. Then going concern concept was there. Then accrual concept was there. Then materiality and aggregation concept was there. Offsetting concept was there. Comparative concept was there. And consistency of presentation concept was there. These were the 7-8 concepts of general features of the financial statement, right? Now we are moving towards structure and content. Till now, we were only discussing what should be the key elements, what should be the underlying features of a financial statement. Now we are discussing what should be the component of the financial statement, How the component of the financial statement look like, right? We are talking about structure and content. What is the content there? If I talk about the structure of the financial statement, if you have seen any annual report, right? In annual report, there are a lot of information. Have you seen any annual report? There is a lot of information in annual report, right? And in all those information, one set of information is the financial statement, right? There is a board of directors report. There is a management discussion and analysis report, right? There is a corporate governance report. There are a lot of things in the annual report. Okay. So let me show you the annual report again. I hope this annual report is visible. You can see there is a chairman statement, corporate information, board of directors, major achievements, financial highlights, board of directors report, annexures, MD&A, corporate governance, BRSR, and there is a financial statement, standalone, console. Right? Friends, even this fact is written in your Ind AS 1. It says that in a particular document, right? Your financial statement should be clearly distinguished from other information. Like I have shown you in the annual report, the financial statement section has to be separately called out, has been separately called out. Reporting period. It says that your reporting period should be at least annually. You have to report your number at least once in a year, for a year. You have to explain your reporting period if it is longer or shorter. If it is longer or shorter. Okay. For example, the company was incorporated in the month of January. Okay. And 15-month financial statement is required in case of the first year, right? In case of the first year, the company can club this 3 months with the next 12 months, and the company can show 15 months financial statement, right? Friends, in this case, the company has to disclose the fact that the company has a longer reporting period because the company was incorporated in the month of January, and now the company is presenting the financial statement of 15 months. Or the company has been incorporated in the month of June, and the company is preparing the financial statement of 9 months only for the period ended 31st March. The company has to explain this fact in the notes to accounts. Information required. What are the information required in the financial statement? Name and change. The name of the company. For example, balance sheet. As at 31st March 2024, the balance sheet of Bharti Airtel Limited. Balance sheet of Reliance Industries Limited. Whether it is an individual financials or group financials. What is meant by individual or group? Whether it is a standalone financial statement or a consolidated financial statement. It is required to be disclosed. I have shown you now in the financial statement section, standalone, consolidated, right? So whenever you see the financial statement, consolidated financial statement will always be called out. Probably standalone word may not be there, but if anything is not been there, so we understood that it is a standalone. But for consolidation, always it should be their consolidated balance sheet, consolidated P&L, right? So company needs to call out whether it is a standalone financial statement or consolidated financial statement, right? And that is why I've shown you this Hindustan Aeronautics Limited balance sheet. They are calling out it is a standalone financial statement, right? Period covered. What is the period covered? Is it for the year ended 31st March? Balance sheet as at 31st March. So you have to call out the period also. Every company is doing that. Currency. Are you presenting your numbers in INR, US dollar? You have to state your currency also. Level of rounding off. Right. Again, as I told you, the guidance of level of rounding off is not there in Indian accounting standard. The guidance of rounding off is given in Schedule 3. Right? You remember I have told you if the total income is up to 100 crores, you can round off in hundreds, thousands, lakhs, and millions. Right? But if your total income is more than 100 crore, in that case, you can round off in thousand, lakhs, millions, and crores. right? This is what the rounding of provision says. It is given in the schedule 3, division 2 to schedule 3, and you have to refer that for rounding off. But in the financial statement, you have to disclose the level of rounding off. For example, rupees in million. For example, rupees in million, right? Is that clear? Clear or clear, friend? Is that clear in mind or clear from mind? Tell me, what is that? Tell me, what is that? From mind or in mind? Clear in mind. Very good. Yeah. Let me show you this annual report again, and you can see that the name of the company, Hindustan Aeronautics Limited. It is a standalone balance sheet as at 31st March 2022. The currency is rupees and the rounding off is rupees in lakhs. Can you see that? Can you see that? Yeah. Great. So now let's go to the presentation again. And friend, now we are discussing one by one the structure and content of balance sheet. And friends, before discussing the structure and content of the balance sheet, first of all, as I told you in the last class, the format, when I say format, I mean to say this tabular format. You understand, na? T-shaped balance sheet is not allowed. We have a vertical shape of balance sheet, not a horizontal shape of balance sheet. You all are aware. Friends, the format of the balance sheet is given under division 2 to schedule 3. And all the companies are required to follow that format. The format is not given in Ind AS 1. Ind AS 1 provides a content that what should be the structure, what should be the structure of this balance sheet, right? So Ind AS provides the guidance. Ind AS provides the pillar. For example, you are constructing your flat. You have, you have engaged an interior designer for your flat. And you told interior designer, please suggest me that how my flat should look like, how the things should be placed. So interior designer is saying your TV should be at this place, right? Your TV unit should be at this place. Your dining table has to be there. And your dining table size is this by this. Your sofa will come here, right? Your paintings, your sceneries, all these has to be hanged here, okay? So it is giving you the interior designer is giving you the guidance that this has to be there, okay? But which brand of TV you have to purchase, which brand of furniture you have to purchase, it is not talking about that. How your furniture should look like, it is not talking about that. Likewise, Indian accounting standard is an interior designer. He talks about your balance sheet has to be bifurcated into current and non-current. You have to present your balance sheet on the basis of current and non-current, right? You can present on the basis of liquidity if it is more relevant. And these are the minimum items which has to be presented on the face of the balance sheet, right? But how it is going to be presented, is it T safe, V safe? No. Ind AS does not talks about that. Who talks about that? Format is given by division 2 to schedule 3, right? So friends, when I started talking about this schedule 3, and you remember, if I'll show you the first slide, which I discussed in the last class, and I'm again showing that slide for your ready reference, you can see that when I talked about balance sheet, I talked about schedule 3 and Ind AS 1. Schedule 3 gives the format. The format is given by schedule 3, right? And you have to also refer the guidances which is given in Ind AS 1 for the purpose of this balance sheet, right? Students, are you enjoying the session? Are you able to understand the thing? Yes or no? Yeah. Let me see on the query box also. Yeah. Abhishek is saying, sir, please repeat the turnover criteria for rounding off. So it is not a turnover criteria, Abhishek. First of all, it is a total income criteria. It is a total income criteria. And total income criteria says that if the total income is up to 100 crores, you can round off in 100, 1000, lakhs, and millions. If it is more than 100 crore, you can round off in thousands, lakhs, millions, and crores. So this is what it is given in this criteria. Okay, right? Any other question? Any other question? Just let me see if there is any question relating to this. Just one correction, friend. In the rounding of criteria, when the total income is more than 100 crore, then thousands criteria is not there. My bad. Okay, only 3 units are there: lakhs, millions, crores. But when it is up to 100 crore, then 100,000, lakhs, and millions, right? Up to 100 crore. Okay, so up to 100 crore, there are 4 units of rounding off: 100,000, lakhs, and millions. But when it is more than 100 crores, then lakhs, millions, and crores. Only 3 units of rounding off. Right? Clear? Clear or clear? Clear. Okay. Yes. Now let's come to the balance sheet. As explained, so this Ind AS 1 talks about that balance sheet has to be presented in on current and non-current distinction basis, right? Your every line item of balance sheet has to be bifurcated into current and non-current. And you have seen that there is a non-current asset, there is a current asset, right? There is a non-current liability, there is a current liability, right? You must have seen that section. I have shown you in the balance sheet in this annual report also. Early, first there is a non-current asset and all the non-current assets are presented. Then there is a current asset, all the current assets are presented. Then equity, then non-current liability, then current liability, right? It says that you can classify on the basis of liquidity if more relevant. For example, banks, NBFC. If you see the annual report of Bajaj Finance Limited or Bajaj Finserv Limited, you will not find the balance sheet into current and non-current. You will find the balance sheet on the basis of liquidity. The high liquid item has to be presented first, and the less liquid item has to be presented later on. Means the balance sheet has been bifurcated into financial and non-financial. Second example, if the company is preparing its financial statement not on a going concern basis, in that case, the company has to present the numbers on a realizability basis. If the company is saying, I am not going to survive for more than 12 months, there is no question of non-current. In that case, the usefulness of the financial statement or usefulness of the balance sheet will only be there if it has to be, disclosed in the order of liquidity. Correct? So the basic principle is the balance sheet has to be bifurcated into current and non-current, but you can classify on the basis of liquidity if you find it more relevant. For example, in case of banks and NBFC companies, in case of a company which is not prepared its accounts on a going concern basis. Obligatory or minimum line item on the face of the balance sheet. This standard also talks about what should be the content of the balance sheet. What should be the content of the balance sheet? For example, this standard talks about that you are required to present property, plant, and equipment, investment property, intangible asset, right? Financial asset, trade and other receivable, cash and cash equivalent, biological assets, inventories, investment accounted for using the equity method, non-current assets held for sale, trade and other payable, provision, financial liability, liabilities and assets for current tax, deferred tax assets and liabilities, NCI, issued capital and reserves, right? So standard has given para number 54 of Ind AS 1. Para 54 of Ind AS 1 has given you the minimum content, the minimum content. This should be the minimum content which has to be presented on the face of the balance sheet. Now the question arises, sir, biological asset, right? What is a biological asset? Biological asset is a living animal or plant. गाय भैंस. Biological asset is a living animal or plant. Sir, we have not seen biological asset in many balance sheet, and you are saying this is a minimum line item on the face of the balance sheet, right? Friends, the objective of the standard or the intent of the standard is you need to present these line items minimum on the face of the balance sheet if these line items are applicable to the company. Bharti Airtel Limited does not have any biological asset. So what relevance will be there if Bharti Airtel will just present that biological asset, current year nil, previous year nil? How does it helps, or how does it impacts the usefulness to the investors? If someone will say nil nil, there are lot many line item which is zero in current year, zero in previous year, which is not applicable to the business of the company. Standard says that these line items are required to be presented on the face of the balance sheet if there is a figure either in the current year or in the previous year. If either in the current year or in the previous year, if the figures are not there in both the years, then you are not required to present these line items. Right? Clear? Making sense also? Now there is a question for you. As per Ind AS 1, which one of the following item is not required to be shown on the face of the balance sheet? Biological asset, property, plant and equipment, investment property, contingent liability, intangible assets. I am waiting for the answer. Let me see how many students will be able to give the right answer. Contingent liability, of course. Contingent liability is a off balance sheet item. Contingent liability is a off balance sheet item. Right? It's a off balance sheet item. So Bindu is asking a question, sir. I have a question on offset, sir. Is vendor credit offsetted? Yes, Bindu. Let's say if you have to pay to a 1 lakh rupees to a vendor, and either you have given an advance to the vendor or the vendor has issued you a credit note, right? So in that case, that credit note can be adjusted with the vendor amount. Okay. If you have a right to offset that credit note right now. For example, in some cases, Bindu, you are dealing with a vendor or a supplier and you have to pay 10 lakh rupees to the vendor. Vendor has already issued you a credit note with a condition. This credit note will be utilized in the future purchases. It means when you purchase, when you enter into a transaction in future, then only you will be able to offset this credit note. In this case, this credit note cannot be offsetted from the current outstanding. But if the vendor does not gives you any terms and condition, and if this credit note is immediately available for offsetting or utilization, in that case, it can be offsetted. Right? Is that clear, Bindu? Yes. So majority of you have given the right answer. It's a contingent liability. Friends, how many of you are aware about the concept of current assets and non-current assets? How many of you are aware about the concept of current asset, non-current asset, current and non-current classification? This is exactly same what we have discussed in IGAP or accounting standard. Please do let me know how many of you are aware about the current and non-current concepts. Few students are aware. Rakesh has confirmed that, sir, I am aware about the current and non-current concept. Dhara is also saying that. So many of you have seen that concept, right? Current, non-current. Okay. What is current? What is non-current? Let's discuss this one by one again. And in the balance sheet, it says that balance sheet has to be classified into current and non-current. Okay. Now, sir, what is non-current assets? Let's discuss this non-current asset first. The non-current assets are very simple. Any asset which is not current is non-current. Any assets which is not current is non-current. Very simple definition. जो करंट नहीं है वो नॉन करंट है, राइट? जो करंट नहीं है वो नॉन करंट है. Sir, then what is current? What is current asset? Standard says that current assets are those assets which is expected to realized or intended to sell or consume in its normal operating cycle. Right? If any asset which you expect to realize or intends to sell or consume in the normal operating cycle. Sir, what is a operating cycle? Operating cycle means a cycle which converts cash into cash. Sir, what are you saying? Which convert cash into cash. What does it mean? I'll explain. Normally, the company purchases raw material, right? And the raw material purchase and delivery took place in a period of 3 months. So how much time it took to purchase a raw material? 3 months. The company processed this raw material to get the finished goods. Normally, the production cycle will take 6 months. 3 plus 6, 9 months. Then the company will be able to sell this finished goods in a period of 6 months. So how much time? 3 plus 6 plus 6. How much time is there? 15 months. 15 months. And the company is able to realize the money because in a kind of industry the company is operating, the company has to give a credit of, let's say, a credit of 6 months. Okay. Or let's say 3 months. So 15 plus 3, 18 months. So the company has spent cash and the company is realizing cash from the debtors in 18 months. So what is my operating cycle in this case? What is my operating cycle in this case? What is my operating cycle in this case? My operating cycle in this case would be how much? 18 months. My operating cycle is 18 months, right? Means in 18 months, my operating cycle, in 18 months, I am able to convert cash from cash, right? Convert cash from cash. Clear, friends? Any item which is expected to be realized within 18 months or which is expected to be consumed in the process within 18 months is considered as a current assets. It is an operating cycle. Sir, if from some data I will be able to realize in 18 months, I mean to say 3 months, from some, let's say 7 months, 6 months. So I have to see the data wise. Answer is no. What is a general practice? For example, generally, it always takes 3 months to get the delivery of raw material. Generally, the production cycle is 6 months. Generally, the waiting period or selling period is 3 months. Generally, the company provides a credit period of 3 months, right? It's a credit policy of the company. Okay. So you have to see on an average. You have to see the general, that what is the general period. It is not like that, some are paying me in 18 months, some are paying me in 24 months. It is not like that. Okay. So whenever the company has a different operating cycle, normally the operating cycle of the company is 12 months. But whenever the company has a different operating cycle, it is required to be disclosed separately. Okay. Or the second, it holds the asset. It holds the asset primarily for the purpose of trading. Maruti. So Tata Motors. What is the nature of these cars for Maruti or Tata Motors? Is it current or is it non-current? Is it current or it is non-current? The nature of the car for the Tata Motors Limited. The cars for the Tata Motors Limited, is it current or it is non-current? Tata Motors Limited are manufacturing cars. They are manufacturing cars, and they have to sell these cars. It means these are holding these assets primarily for the purpose of trading. For the purpose of trading, right? And hence these cars are not inventory. Sorry, these cars are not PPE. These cars are inventory for Tata Motors Limited or Maruti, right? Sir, how come? And this Tata Motors is selling the same car to Infosys. These cars become a PP, become a fixed asset for Infosys. But for Tata Motors Limited, these cars are inventory. Why? Because they hold this asset primarily for the purpose of trading, for the purpose of selling. So this is a current asset. This is an inventory, and hence it has to be shown as a current asset. Right? Third, it expects to realize the asset within a period of 12 months after the reporting period. In the first case, we talked about the operating cycle. In the third case, we are talking about within a period of 12 months, right? So generally, if you have seen the annual report of a company, right, they are giving what is current asset, what is non-current asset. I mean to say, what is current, what is non-current. They are giving this kind of a classification. They are giving the accounting policy for current, for non-current, right? So friends, in those accounting policies, they are disclosing the meaning of current, the meaning of non-current. Okay. So Abdul Kadir is saying, likewise, the software for Infosys will be inventory and intangible asset for Tata Motors. Bang on, Abdul. You are absolutely right. Yes. So for Infosys, because Infosys is selling those softwares, right? And Infosys is considering those as an inventory. But at the same time, if Infosys is selling those software to Tata Motors, Bharti Airtel, then it will be intangible assets. Okay. So the third one is if it expects to realize the asset within 12 months after the reporting date. Let's take an example. You have purchased your goods on credit, right? Now, the contract with the debtor is that you have to get the money within a period of 3 months, because the credit period or the credit policy of the company is 3 months. Now, when you are having a dialogue with the debtor, dialogue with the customer, you will find that the customer is in cash crunch, right? And the customer has told you that, look, Mr. XYZ, I have so much obligation in the next 1 year, and I would only be able to pay you 12 months after this date, right? So let's say on the reporting date, you will only be realize this money after 1 year. And this debtor or customer is okay to pay you interest for that period, right? So sitting on the reporting date, you are saying that, oh, I'll only be able to realize this asset after 12 months from the reporting period, right? The debtor has already told you. And friends, one mistake we always make in while appearing in examination, while solving the problem in exam also, at times we forget that whenever we are classifying current and non-current, we are thinking about future. We are not thinking about the past. For example, and even these mistakes was happened, this mistake was occurred by the chartered accountant also. For example, you have sold your goods on credit and the debtor has not paid you for last 2 years. Okay, you are following up with the debtors and he is saying, okay, I'll pay you next month, I'll pay you next month. He is not paying you. होता है ना, आप अपने दोस्त को भी पैसा दे देते हो, आप मांगते रहते हो, you are paying money to your friend and you are just chasing him that please return my money, please return my money, and he's saying that I'll pay tomorrow, I'll get the money from my dad, then I'll pay you. Okay, so what people are thinking, it's been 2 years when I haven't received the money, so it means it is non-current. Answer is no. Sitting on a balance sheet date, what you are expecting today, are you able to realize or you are not able to realize within period of 12 months or within an operating cycle? This is how this current and non-current classification will be there, right? It's not about the past, it's about the future. Okay, so friends, in this particular example which I have taken, that the customer has told you, I'll not be able to pay in the next 12 months. I'm damn sure. And I'm ready to pay you interest for that. It means you are expecting to realize this money after 12 months from the reporting date. So it is not current. It is a non-current asset. It is not a current asset. It is a non-current asset. Is that clear, everyone? Clear in mind or clear from mind? Clear in mind. Okay. So Abdul is saying, though it is classified under current asset, aging should be maintained. Of course, yes. So Abdul, there are two things. In the yesterday class, as I told you, the aging related requirement are coming from division 2 to schedule 3, right? The aging related requirement are not coming from Indian accounting standard. When you are prepare your financial statement, is that a current asset? Is that a non-current asset? The guidance is coming from Ind AS 1, para 66 of Ind AS 1, and the guidance, the same guidance is replicated under division 2 to schedule 3 also, right? So likewise, if I talk about preparation of balance sheet, this current non-current guidance is there in Ind AS 1. I have shown my data as a current, few data as non-current, right? But as far as aging is concerned, you have to give the aging, which is past. You have to give the aging for current as well as non-current in your financial statement. Okay. Let me see if there is any query on the chat box also relating to this topic. Yes. Okay. I believe you guys are very much clear on this. Yeah. Great. Second example, and typically it is there in every company. Let's say the company has paid a security deposit for telephone, right? The company has paid a security deposit of telephone. This is an asset for the company, right? And the company does not expect that I'll recover this security deposit or I'll get the refund of this security deposit within a period of 12 months. The company is preparing its books of accounts on a going concern basis, right? And this says that we want to operate in a long run. Our vision is not short term. Although if the company will surrender the telephone connection tomorrow, the telecom company is obligated to pay to that customer, to pay to this company, right? But the company does not expect that I will get the refund of this security deposit within a period of 12 months, right? So in this case, the company is showing this security deposit as a non-current asset, right? As a non-current asset. Okay. But let's say you are an article in some chartered accountant firm and you went for the audit. So the company has paid a security deposit for one of the premises, one of the branch, right? And now the company has decided to relocate from that branch, from that place to some other place, right? And the company was showing this security deposit as non-current because the company wants to operate from that premises as far as last reporting date is concerned. But now, when the company is finalizing the balance sheet on 31st March 2024, in March 24 itself, the company has decided to relocate from this place to another place. In this case, of course, the company has to surrender the connection, right? If the company is required to surrender the connection, the company will get the refund of the security deposit within a period of next, let's say 3 to 5 months, right? So friends, in this case, will it be current or will it be non-current? It will be current, right? It will be current. So I believe we all have understood the first, second, and third item of current assets. The last one, when the asset is cash or cash equivalent. What is meant by cash? You all understand, right? You know, after demonetization, everyone understands the meaning of cash and the importance of cash, right? So friends, if the asset is a cash or cash equivalent, what is meant by cash and cash equivalent? What is meant by that? Cash and cash equivalent? Friends, cash equivalent is defined under cash and cash equivalent is defined under Ind AS 7. And it says that if an asset or a money which is highly liquid in nature, highly liquid means which can be converted into cash within a period of 3 months, right? Any item which can be converted into cash within a period of 3 months, right? And which does not have a significant risk of change in value. And I will explain with the help of an example. Let's say the company has purchased share of Tata Steel Limited. The company has purchased shares of Tata Steel Limited. Now, let's say the company has purchased the share of Tata Steel Limited on 30th March 2024. Now, tell me whether this investment in Tata Steel is highly liquid or not. Yes, it is highly liquid now. Tomorrow, when the market will open, if the company wants to sell this investment, the company will be able to sell this investment, right? When the market will open tomorrow and the company wants to sell this investment, the company will be able to sell this investment. So it's a highly liquid in nature. And the standard talks about the assets which can be converted into cash within a period of 3 months. Within a period of 3 months is considered as a cash and cash equivalent. But this investment in share will not be considered as a cash and cash equivalent, irrespective of the fact that it is highly liquid. Why? Because of the another reason. What is another condition? Because it has a significant risk of change in value. Today, if you have purchased the share of Tata Steel at a price of 150, tomorrow you are not aware that whether the price will be 180 or the price will be only 80 or the price will be only 80 rupees. You are not aware that what would be the price. Either it is only 80 or whether it is 180. You are not aware. Right? Which means that there is a significant risk of change in value and hence it is not a cash and cash equivalent. But let's say you have invested your money into the fixed deposit with State Bank of India, into the fixed deposit with State Bank of India. In that case, and this amount is only for a period of 3 months. So first of all, you will be able to convert this fixed deposit, mature this fixed deposit within a period of 3 months, right? And there is no significant risk of change in value. If you have in deposited 100 rupees, the rate of interest is 3 rupees. You will be able to know that, I will receive 103 rupees at the end of the maturity period. 103 rupees I'll receive at the end of the maturity period, right? So there is no risk of change in value. There is no significant risk of change in value. So standard says that if an asset is cash and cash equivalent, right, it has to be shown as current asset until and unless if that cash and cash equivalent is, for example, the fixed deposit which has been placed under lien. Under lien means the company has, deposit this money with the bank or fixed deposit with the bank for the purpose of securing the bank, for the purpose of securing the bank. The bank has given a guarantee on behalf of the company, and bank has asked this fixed deposit, right? So if this fixed deposit is restricted or under lien, right, it cannot be considered as a current asset if this fixed deposit cannot be matured or withdrawn for a period of 12 months from the reporting date, right? Otherwise, it is considered as a cash in cash equivalent. It is considered as a current asset, right? Any doubt, any question on this current asset? Any question on this current asset? Sir, does that mean Bindu is asking a question? Does that mean on the balance sheet date we have to analyze whether it is realizable 1 year, then it is current, otherwise it is non-current. Aging is past classification. You are absolutely bang on, Bindu. You are absolutely bang on. You are absolutely right. Right? So you are thinking about the future. Will I be able to realize? Will I not be able to realize? Abdul is saying, but sir, the fixed deposit won't be classified under short-term loans and advances. Abdul, you are right. I'm not talking about that. You are not that you are required to show this as a short-term loans and advances. In Ind AS, it has to be shown as a other bank balances or other financial assets. So what happens, Abdul? And let me explain this fact with the help of an example. Uh, I hope my Excel file is visible, guys. I hope it is visible. Is that visible? Item number 1. And I'm talking about the fixed deposits. A Limited deposited A Limited has taken fixed deposit for a period of 3 months. For a period of 3 months, as it, you know, of 1st February 2024. As it February 2024, amounting to rupees 10,000, right? And we are talking about, so A Limited is preparing balance sheet asset and for the asset and for the period ending 31st March 2024, right? Just how the below fixed deposit will be classified in the balance sheet. Okay, let's go by this example. Everything will be clear to you. Go by this example. A Limited has taken fixed deposit for a period of 3 months as at 1st February 2024, amounting to rupees 10,000. Friends, what is the original maturity period? What is the original maturity period in this case? 3 months, right? So as on 31st March, this fixed deposit will remain outstanding for a period of 1 month. But the original maturity period was 3 months. So when you read Ind AS 7, it says that cash and cash equivalent, you have to see the original maturity period of 3 months or less, right? So this is the balance sheet. In the balance sheet, it will be shown as a, let's say this is a non-current asset. Non-current asset. This is a current asset. This is a current assets. In the current assets, you will show this fixed deposit as a cash and cash equivalent. Right? 10,000 rupees. Second example. A Limited has taken fixed deposit for a period of 15 months. As it 15, as it 15, or let's say 15 December 2022, right? 15 December 2022, or I would say 23, no, 22. 15 December 22, 15 December 23, 1 year has been completed. Okay, I'll write it the 1st January 2023. How much period was elapsed? 1st January 23 means 12 months, 315 months. Okay, 1st January 23. And instead of 15 months, let me give it as a 20 month, right? As at 1st January 2023 from HDFC Bank. HDFC Bank. Right. What is the original maturity period? The original maturity period is 20 months, right? But what is the remaining outstanding period as on 31st March 2024? The original maturity period is 20 months. It will never be cash and cash equivalent. So now, what is the remaining outstanding as on 31st March 2024? As on 31st March 2024. So this will be realized after 20 months, means on 1st January 2023, we have invested. So 12 months have been completed from 1st January to 31st December. 3 months have been completed from 1st January 24 to 31st March 24. So as on 31st March 24, 15 month has already been completed. 5 months are remaining as on 31st March 2024. It means it is a current asset, but it has to be shown as a other bank balances. Other bank balance. Right? And what is the amount? Has I given the amount? Let's say as it from HDFC Bank for rupees 50,000. For rupees 50,000. Now, third example. A Limited has taken fixed deposit for a period of, let's say, for a period of 15 months as at 1st February 2024 from ICICI Bank for rupees, how much? For rupees 25,000. Tell me what is the nature of this fixed deposit? What is the outstanding period as on 31st March 2024? What is the outstanding period as on 31st March 2024? We are talking about balance sheet as at 31st March 24. As at 31st March 2024. Yes, outstanding period is 3 months. It is more than 12 months. So it has to be shown as a non-current asset. Where? Other financial assets. Other financial assets. 25,000. I hope you guys are able to understand that how these fixed deposits on the basis of original maturity, on the basis of remaining outstanding period, how these fixed deposits are going to be presented in the balance sheet. Is that fine? Is that fine, friends? Is it fine or it is not fine with you? I hope this example has, solved your clarification, solved your questions on the classification. Yeah. So shall I move forward? Otherwise, we'll not be able to complete the session even. Yes. Now let's discuss the current and non-current liability. Now, sir, what is a non-current liability? The liability which is not a current liability is a non-current liability. It's a non-current liability, right? Hence, it says that whatever liability is there, like your current assets, if you are expecting to settling your liability in the normal course of operating cycle or within 12 months, right? Trade payable. And you have seen that the companies are showing trade payable as a current liability. Why? Because they are settling these trade payable in the ordinary course of business, in the normal course of business. Or they are settling this trade payable within 12 months from the balance sheet date, within 12 months, right? Or they are holding this liability primarily for the purpose of trading, primarily for the purpose of trading, right? Friends, in this case, it has to be shown as a current liability. Now, one important aspect is there. One important aspect is there. And a liability has to be shown as a current liability if there is no unconditional right to defer the settlement for at least 12 months, right? For defer the settlement for at least 12 months. Let's say I have purchased goods from a customer. Oh, sorry, I have purchased the goods from the supplier, not customer, supplier, from vendor. So vendor is giving me a credit of 1 month, right? So as on balance sheet date, I have purchased the goods. Vendor has given me a credit of 1 month. Can I show this liability as a non-current? Can I show this liability as a non-current? Answer is no. Why? I don't have any unconditional right to defer the settlement for at least 12 months from the reporting date. मतलब मैं इस लाइबिलिटी की सेटलमेंट को 1 साल से ज्यादा डेफर नहीं कर सकता, राइट? सो आई कैनॉट शो दिस लाइबिलिटी एज अ नॉन करंट. Second example, I have purchased the goods on a credit basis and I have already entered into agreement with the supplier, with the vendor, that I will settle this liability after 12 months from the reporting date. Means, let's say I have purchased the goods on 31st March and I have told him that I'll pay after 12 months, and I have entered into agreement. So we have already, we have already agreed that this payment has to be made after 1 year. So it means I have an unconditional right that I'll defer this settlement at least 12 months from the reporting date. I am not obligated to pay within 12 months, right? The classic example is bank loan. You are taking a home loan for 20 years. Every year you are paying EMIs. Whether bank is asking you to pay all the EMIs upfront whenever the bank desire? Answer is no. The bank will only chase you. The bank will only call you if your one of the EMI get bounced. And then bank will not say pay all EMIs. Bank will say pay your last EMI which you have defaulted right now. And friends, that is why when you have taken a loan for 20 year, 5 year, 10 year, then whatever the obligation is there for a period of next 12 months, you are showing as a current liability, because you cannot defer, you cannot postpone your next 12-month EMIs for more than 12 months, right? If I have taken a home loan and I'm paying EMIs on a monthly basis, what happens? Every month I have to pay EMIs. For current month I cannot postpone, for next month I cannot postpone. Means in the next 12 months मुझे अगले 12 महीने में जो भी EMI पे करनी है वो उन 12 महीने में ही करनी है, राइट? और 12 महीने के बाद की जो EMI है वो मुझे 12 महीने के बाद ही करनी है. So I don't have an unconditional right to defer the settlement for next 1 year EMIs, and hence whenever there is a term loan, whenever there is a home loan, whenever there is a loan for more than 1 year, in that case, the companies are showing the first 12 months EMI as a current liability, and the other than 12-month EMI is as a non-current liability. This is what the companies are showing. Second example, the company has taken a loan from the bank, right? And on the reporting date, the remaining outstanding period is 6 months only. The remaining outstanding period is 6 months only. Friends, is it a current liability or it is a non-current liability? In the next 12 months, so in the next 6 months, the company has to pay this entire loan. Let's say no EMI is there. The maturity date of the loan is after 6 months from the reporting date. Is it current or non-current? Of course, it is a current liability. It is a current liability. Friends, before 31st March, the company has entered into a contract with the bank, and the bank has agreed that this loan will be rolled over, right? The loan will be rolled over. On the maturity date, the loan will be automatically, automatically renewed and automatically become another loan for, let's say, 2 years. Means the loan will be rolled over and the remaining period will be 2 years from the date of expiry of the loan. And this agreement has been made before end of the financial year. Friends, is it a current liability or is it a non-current liability? Since the company has already entered into a contract with the bank, on the reporting date, whether the company has an unconditional right to defer settlement? Yes, the company got the unconditional right to defer the settlement of this loan by entering into a contract before 31st March. Is that clear? Is that clear or not clear? I hope it is clear to everyone. Let me see if there is any query on the query link of ICAI. Yes, Bindu is clear. Abdul, is that clear to you? Okay. This was the concept of current asset and non-current asset, current liability and non-current liability. Yes, now please answer me this question. Inventory or trade receivables of Pluto Limited are generally realized in 15 months. Should Pluto Limited classify such inventory or trade receivable as current? Tell me what is the right answer. Yes, it has to be classified as current. Why? Because in this case, the operating cycle become 15 months, right? Because generally the company realize money in 15 months. So it is within the operating cycle. Since you remember, when on the day one, I have discussed the overview and roadmap for applicability, I have discussed one carve out. You remember that carve out? You remember that carve out? If a company has taken a long-term loan and that long-term loan becomes repayable on demand due to violation of some terms and conditions, right? But the company has made good the loss, made good this default, and before approval of the financial statement, the company has talked with the bank and bank agreed that, okay, I'll not demand the payment on demand. I'll demand the payment only as per the predetermined period, as per the predetermined date. In that case, we have told that it will be considered as a adjusting event and that loan will continue to classify as a non-current liability. You remember we have discussed this in detail. I've also said the Excel file for the day one, it is uploaded, right? Or you can refer the day one roadmap and overview of Ind AS and roadmap for application. You can refer that video, right? And in that video, I have explained in detail that what is the carve out which we have taken and what carve out says, right? It says that in IFRS, what happened? IFRS says that that loan has to be shown as a current liability. right? It will not be considered as a adjusting event. But in Ind AS, we are saying that if it was a non-current loan and it become current on the reporting date just because there was some default of the terms and conditions. But if the default was corrected before approval of the financial statement in the board meeting, we will consider this as an adjusting event and we will continue to classify this loan as a non-current loan. This is the carve out which we have taken, right? Sorry. Abdul is asking a question. Sir, if a company do agreement on 1st March 2024 to roll over the loan to be matured on 30th March 2024 for say 10 months, so will it be classified under non-current asset? Abdul, first of all, we are talking about loan. It is a non-current liability. It is a liability. It is not an asset, right? Is that clear? So the maturity was 30th June 2024 and the company has already entered into an agreement to roll over this loan for the next 10 months, right? For next 10 months. So this next 10 months from 30th June 2024, when this 10 months will expire? On 30th April 2025, right? On 30th April 2025. So you are talking about 31st March 2024. So on 31st March 2024, you have an unconditional right to defer a settlement for the next 12 months, right? For a period of more than 12 months. So you are obligated to pay this loan on 30th April 2025, which is 13 months from 31st March 2024. So it will be a non-current liability. It will be a non-current liability, right? Let's discuss this case study. Really Rooster Inc. This is the name of a company. Has a December 31st year end. As of June 30th, 2019, RRI obtains a $1 lakh of loan from a bank for a new chicken coop facility. All right. So the company has taken a loan on 30th June 2019. The loan is due in 24 months. The loan is due in the period of 24 months. It means on 30th June 2019, the loan has to be repayable on 30th June 2021. In December 2019, means after 6 months, the loan is still repayable for a period after 18 months. RRI spent too much of its cash on its holiday party and incurs a debt covenant violation as of 31st December 2019. So this company was supposed to invest the money into a manufacturing facility, right? And as on 31st December 2019, on the reporting date, the company has enjoyed this money on parties, which was not a condition of the loan, right? Because whenever you take the home loan, the bank says that you have to use this home loan for the purchase of home. But if you'll enjoy and spend the money on the parties, you will incur a debt covenant violation. Okay. Friends, as a result of the violation, the loan becomes due within a period of 30 days. On 31st December 19, although it was supposed to be payable after 18 months, as per the predetermined period. But now due to this violation, this loan has to be paid within 30 days. So friends, tell me whether it will be non-current or current. It will be current because it is payable within 30 days now. Let's read further. At this time, the company asked the bank to waive the violation. The company discussed with the bank, right? The company discussed with the bank. On January 5, 2020, means after 5 days, the bank agrees to waive the violation. Bank said, okay, I'll not demand the money. The company issues its financial statement on 25th January 2020, right? This is the date on which the board meeting was happened and on which the financial statement were approved, right? How should this loan be classified, current or non-current, in the company's balance sheet as on December 31st, 2019 under IFRS and Ind AS? Under IFRS and Ind AS. Friends, in IFRS, it should be classified as current because IFRS says that this was a current on the reporting date. It has to be shown as a current, right? But in Ind AS, we have taken a carve out and we have said that we understand it was current on the reporting date, but we have already discussed with the bank and we have made good this problem. We have made good this violation, and hence under Ind AS it has to be shown as a non-current. Under Ind AS it has to be shown as a non-current. Under IFRS it has to be shown as a current. Friends, please refer my video under day one. Okay, day one video. You will find that I will explain this concept in detail. Okay, is that clear? So friends, it's 8:36 now. Let's have a 5 minutes break and then I'll start the structure and content of statement of profit and loss. So let me see if there is any question. Otherwise, I'll move on to the next part, which is statement of profit and loss. Okay, so there is no question as of now. Whatever queries were there on chat box or in that query link, I have already covered all the queries. Yes, now let's discuss about the profit and loss. And friends, first of all, uh, how many of you how many of you have seen the profit and loss statement of P&L or P&L account? How many of you have already seen that? How many of you have already prepared that? How many of you have already audited that? Many of you, right? And I would say each and every one of you, right? You guys have seen the P&L. You guys have audited the profit and loss. You guys have drafted the profit and loss, right? So let me show you the profit and loss account and then I'll discuss one by one. Okay. First of all, let me share my Excel file and please confirm if my Excel file is visible. Please confirm if my Excel file is visible. Is it visible? Okay. Okay. This is a statement of profit and loss for the period ended 31st March 2024. Right. And what is my profit and loss? And you all have seen that in my profit and loss, there is a revenue from operations. There is a other income, right? Just give me a second. There is a revenue from operation. There is a other income. Then there is a total income. Then there are employee benefit expenses, other expenses, impairment losses, depreciation, finance cost, right? These all items are there in my profit and loss account, right? And we are disclosing these expenses on the basis of nature-based classification. You remember when I discussed the first class, I have talked about the convergence, adoption versus convergence. And I said that we have taken some carve out, carve in, removal of options, right? So we discussed that. Okay. So in IFRS, the presentation of expenses, on the basis of the presentation of the expenses on the basis of nature as well as function, both are allowed. But in Ind AS, the expenses are required to be presented only on the basis of nature-based classification, right? This is what we discussed in the first class. So this is a normal P&L which each and every one of us are aware of, right? And then there is a profit before tax and other item. And friends, there are three items, which is extraordinary item, exceptional item, and prior period item. Extraordinary item, exceptional item, and prior period item. First of all, let's talk about prior period item. Friends, are you aware about the prior period item? This was there in your IGAP, in your financial statement, which you are preparing under Indian GAAP, under old accounting standard. If a company has found that there is a prior period error, which the company has found in the current year. So what company is required to do? The company is required to present the impact of that prior period error, in the current year, right? As a separate line item on the face of the P&L. Friends, whether this line item is required to be presented in the Ind AS, considering my yesterday session, when I talked about the application of correction of error, the third balance sheet, right? Do I need to present this prior period item in my profit and loss account as I was presenting in my IGAP, in my old accounting standard? Do I need to present this line item? Yes or no? Answer is no. Why? Because, sir, in our old accounting standard, we were not restating the comparative. We are not giving the third balance sheet. But in Ind AS, Ind AS का rule बड़ा stringent है. In Ind AS, we are required to restate the comparative. You are right, Abhrakesh. We are required to restate the comparative. We are required to restate or give the third balance sheet. We have to, we have to take the correction of error of impact from the date of error till the opening date of the comparative period balance sheet in the opening balance sheet. Then we need to correct the comparative balance sheet. Then we need to correct the current year balance sheet, right? Likewise, we need to correct the comparative P&L also and the current P&L also, and we need to give the disclosures also. I've shown you ONGC balance sheet, right? So friends, and hence this concept of prior period item is not there in Ind AS and IFRS, right? Why? In Ind AS and IFRS, you have to do the retrospective restatement. So please keep in your mind, because most of the time when you are doing your articleship, you are preparing small balance sheet, you are auditing small balance sheets, which are into accounting standard. And there the concept of prior period item is there, but in Ind AS there is no concept of prior period item. I hope it is clear to all of you. And why it is not there? When you refer the day before yesterday video on Ind AS 1, you will be able to understand. I have spent around half an hour on the concept of third balance sheet, right? That how to correct an error, how to change an accounting policy, the impact of correction of error or the impact of change in accounting policy. Is that clear? Okay. Now, friends, another concept. Exceptional item and extraordinary items. Exceptional item and extraordinary item. Friends, again, I am reiterating the format of the P&L. The format of the P&L is given under Schedule 3. The format of the P&L is given under Schedule 3. Right? But the guidance is also given in Ind AS 1. So the first guidance which Ind AS 1 gives, it says that you are not required to present prior period items separately. Why? Because in case of correction of prior period error, you are required to restate your comparative. You are required to give third balance sheet as well. Right? The second guidance in Ind AS 1 says that you have to provide some minimum line item on the face of the P&L, like in balance sheet, like revenue from operations. Of course, you have to present revenue from operations separately. Employee benefit expenses, impairment losses, depreciation, finance cost, tax expenses. These are the line items which you are required to present on the face of the P&L. And these were there in Schedule 3 format also. Second guidance. Third guidance on extraordinary and exceptional item. The standard says that you are not required to present extraordinary item separately. You are only required to present exceptional item. Sir, what is the difference between extraordinary item and exceptional item? And you know categorically why I have given all these words here when it is not part of Ind AS. Probably some faculty will tell you this is the format of the P&L. If someone will teach you Ind AS, so he will say that, you know, this is the format of the P&L, and in this format only exceptional item will come. I have categorically shown you these three items so that you will be able to memorize, visualize, you will be able to understand. This is an important gap or difference between accounting standard scenario, IGAP scenario versus Ind AS scenario. Friends, extraordinary item is not a concept under Ind AS or IFRS. This is a concept under accounting standard. AS5 talks about extraordinary item and exceptional item. What is the guidance? Let me tell you. It says that extraordinary item are those items which is not within the ordinary activity of the entity, right? What does it mean? For example, the company has incurred a loss due to earthquake. Whether having an earthquake is the ordinary activity of the entity? Whether having an earthquake is the ordinary activity of the entity. Yes or no? Of course, no. It is not a bread and butter of the entity. It is not a bread and butter of the entity. Yeah. So it says that, let's say loss due to earthquake, loss due to fire, right? Loss due to natural calamities. Okay. So friends, accounting standard says that the loss or profit which is not due to the ordinary activity of the entity will be considered as a extraordinary item, right? Extraordinary item. What is exceptional item? What is exceptional item? What is exceptional item? Exceptional item are those items which are within the ordinary activity of the entity, but its frequency is less frequent. It's a non-recurring kind of item, and the amount is material. And the amount is material. Friends, and the amount is material. So let's take an example here. Sir, what could be the item which is arising out of the ordinary activity? Let's say all the telecom companies, right? So you understand that there are telecom tower companies also, like Bharti Infratel Limited. So Bharti Infratel Limited is in the business of installing the towers on which the antenna was there of telecom companies. And who are the customer of Bharti Infratel Limited? The customer of Bharti Infratel is Bharti Airtel Limited, Vodafone Idea Limited, Reliance Jio Limited, Aircel Limited, right? So Telenor, many of these companies, telecom companies, were the customer of Bharti Infratel Limited. In 2018, what happened in 2018? And normally what happened, all these companies, right, which are customer, Bharti Infratel used to supply the services on a credit basis, right? And these companies are paying with a delay. The amount these companies are paying to Bharti Infratel with a delay. So likewise, Aircel was also a customer. I believe you have heard about Aircel Limited. Aircel was a customer of Bharti Infratel, and Bharti Infratel used to provide the provision for doubtful debts on all these receivables. Aircel goes bankrupt in the financial year 17-18. And when Aircel goes bankrupt, the company had to incur a huge losses on account of bad debt. Now, question number one. Since the company was doing the credit sales, since the company was doing the credit sales, the question was whether this activity, right, this provision for doubtful debt, whether it was an ordinary activity. Answer is yes. If you will do the credit sales, of course, there will be losses. But having this customer as an insolvent or bankrupt, is it a normal situation or is it an exceptional situation? Will you say every day one of my customer become bankrupt? Yeah. Or when it become bankrupt, you have to take a big hit in your P&L. So it's an exceptional situation. Right? The item is material, the amount is material. And hence the company has shown this item as an exceptional item. The company has shown this loss as an exceptional item. Right? So friends, the difference between extraordinary and exceptional is, extraordinary means those items which are arising from the ordinary activity, which are not arising from the ordinary activity of the entity. Exceptional item are those items which are arising from the ordinary activity of the entity, but the amount is material and the event is non-recurring kind of an event. It's exceptional event, right? Friends, our Ind AS are the concept which has come from IFRS. Our Ind AS are the converged version of IFRS, and IFRS are the global standard, right? There are so many jurisdictions where earthquake is normal. There are so many jurisdictions where every year there is flood. So IFRS says that when you are operating a business, You have a political risk, you have a geopolitical risk, you have an environmental risk. अगर आप बिजनेस करोगे ये सारी चीजें होंगी होंगी, right? And hence it says that nothing is classified as a extraordinary. Either it is a normal or it is an exceptional, right? And friends, hence the concept of extraordinary is not there in IFRS. The concept of extraordinary is not there in Ind AS also. Sir, what happens if an item, let's say, loss due to earthquake? There is a loss due to earthquake. Sir, where we will show this loss? First of all, you need to ask a question. Whether the item is material, whether the loss is material. You said yes, loss is material. Then you need to show it as an exceptional item. But if the loss is immaterial, you have to show it as other expenses, right? Loss due to COVID, whether this loss is material, answer is yes. Show it as an exceptional item. The loss is not material, show it as other expenses. Right? Is that clear? Is that clear? So friends, this I can show you in the annual report, the exceptional item presentation. You can see the exceptional item presentation in the P&L, where the profit and loss before exceptional item in tax. So before tax expenses, this exceptional item has to be shown, right? And the same way I have shown you also, right? There is an exceptional item, then there is a profit before tax, then there is a tax expense, then profit after tax. We have understood now the concept of prior period item and extraordinary item is not there in Ind AS. Okay, is that clear? So this is a normal P&L which we always know, which we have seen, which we have prepared, which we have drafted. Okay, friends. Viraj is saying clear. Any question from anyone? Let me see. Abhishek Sharma has a question on applicability. Am I audible now? Yes, Abhishek, your question is related to applicability of Ind AS, which is the first class topic, right? So I'll take this question at the end of the session. Okay. Friends, now we discussed about the guidance which is given. Ind AS 1 provides the guidance on the minimum line item on the face of the P&L. It says that concept of prior period item does not exist. It says that concept of extraordinary item does not exist. It says that material item has to be presented separately, and hence exceptional item needs to be presented separately. Hence, there is one more concept of other comprehensive income. There is one more concept of other comprehensive income, right? And what is the concept of other comprehensive income? Friends, if you see the P&L, and I'll again show you the annual report. If you see the P&L under IGAP or your old P&L would always stop here, stop here, right? Profit after tax or profit for the period. But in Ind AS, there is a separate section. There is one more section called as other comprehensive income. Your Indian accounting standard P&L is an extended P&L in comparison to accounting standard P&L. Sir, what is this other comprehensive income? Friends, first of all, what is the concept of other comprehensive income? Let me explain that. Let me explain that with the help of this Excel file. Friends, the definition of income and expense. First, I'll discuss the definition of income and expense. The definition of income and expense is income means increase in net assets, increase in net assets. You understand net assets? Net assets means assets minus liabilities. So income means increase in net assets due to a transaction which is happening with a party other than the shareholder. What is the income? Income का मतलब होता है इंक्रीज इन नेट एसेट्स. नेट एसेट्स का इंक्रीज होना. क्यों इंक्रीज होना? जब आप किसी पार्टी के साथ ट्रांजैक्शन करते हो जो कि शेयर होल्डर नहीं है. When you are doing a transaction, right, who is not a shareholder, and from that transaction your net assets are increasing, then it will be called as income. What is the expense? Just mirror image. So expense is decrease in net assets due to a transaction happening with the party other than the shareholder. Means if your net assets are increasing due to a transaction with shareholder, it is not an income. If your net assets are decreasing due to a transaction with the shareholder, it is not an expense. So when your net assets are increasing or decreasing due to a transaction with the parties other than the shareholders, then it will qualify the definition of income or expense. Right? Is that clear? Now I'll give you some questions and then you will be able to understand the concept of other comprehensive income. Let's say the company is paying a dividend. The company is paying a dividend. By paying a dividend, whether your net assets will increase or net assets will decrease, or nothing will happen. What will happen? Whether your net assets will increase or net assets will decrease. Prakash is saying net assets will decrease. You're right. Because you will pay dividend, so your retained earning will be deducted. It will be deducted from your retained earning, right? आपके रिटेन अर्निंग में से कम होगा ना, तो आपके नेट एसेट्स क्या होते हैं? शेयर होल्डर फंड्स होते हैं. टोटल एसेट्स माइनस टोटल लायबिलिटीज इज इक्वल टू शेयर होल्डर फंड्स. Yeah, is that clear? Net assets will decrease. All agree or not agree? Yes, net assets will decrease. But whether this payment of dividend is a transaction with shareholder or some other parties? Is it a transaction with shareholder or others? It is a transaction with shareholder. You will pay dividend to shareholders. Whether it is meeting a definition of expense, the answer is no. It is not meeting a definition of expense. It will not come under your P&L. It will not come under your P&L. Where it will come? Like in our old accounting standard, ICAI, it will be deducted from your reserves and surplus in the retained earning. Students, are you able to understand what I'm explaining here? At least I want an answer in yes or no. Whomsoever have joined on the Zoom can just say yes or no on the chat box. Sumit, Abdul, Chandra, everyone is saying yes. And let me see on the query box. Radhika is also saying yes. Rahul is saying yes. Okay. Dhara and Chandan, they are also saying yes. Okay. Yeah. Friends, let's take another example, right issue. In case of right issue, whenever you enter into a right issue, your net assets will increase because your share capital will increase. But this transaction is with shareholder and hence it is not meeting the definition of income. Now, revaluation surplus on fixed assets, revaluation reserve on fixed assets. Friends, by doing a revaluation of fixed asset, you will have a revaluation surplus, revaluation reserve. So by having a revaluation reserve, your net assets will increase or decrease? Your net assets will increase. But is this a transaction with the shareholder? Answer is no. It's a market driven fair value. This is not a transaction with the shareholder. This is a market value. This is a fair value. So friends, if it is a fair value, if it is a market driven value and it is not a transaction with the shareholder, is it meeting the definition of income? Yes, it is meeting the definition of income. Yes or no? Whatever guidance I have told you, please let me know it is meeting or not meeting the definition of income. Yes, it is meeting the definition of income. Friends, you all are CA final students and tomorrow you will become a chartered accountant. Tell me, revaluation surplus, if it is meeting the definition of income, can I take this as a revenue from operation or other income? Can I take this as other income? It is a notional gain. Can I take this as other income? And I'll distribute the dividend because it will come into my profit. I'll distribute the dividend to the promoter. And tomorrow, what happens when the market price goes down? It is not a realized profit. So Abdul is saying no, sir. But Abdul, I have told you, this is meeting the definition of income. So what should I do? What should I do, Abdul? And hence, friends, hence, Sumit, even if it is an exceptional item, it will flow to your profit after tax, right? So what to do now? So friends, that is why to address this situation, there is one more section which has been clubbed into the profit and loss account, which is other comprehensive income. Please write down. Other comprehensive income is like a reserve category. Other comprehensive income is like a reserves category, right? In other comprehensive income, the items which are more of a reserve in nature and meeting the definition of income and expenses will come here, right? And friends, that is why the earning per share is always calculated on profit after tax. The earning per share is not calculated on other comprehensive income. The total of profit after tax plus other comprehensive income is known as total comprehensive income, right? The earning per share is not calculated on total comprehensive income. Earning per share is always calculated only on the profit after tax. Why? Because this other comprehensive income includes the item which are more of a reserve in nature, right? Is that clear now? Is that clear now? Sir, is there item specified under other comprehensive income? Friends, when you read each and every standard, you will find that the respective standard talks about the treatment of item in OCI. For example, when you read Ind AS 16 property, plant and equipment, it says that revaluation surplus on fixed asset has to be taken to other comprehensive income, right? But friends, just to help you guys, there are around 9 items, 9 items which are specified in the Ind AS 1. I have given those 9 items in my PowerPoint presentation. Those 9 items were there in your institute study material also. Please refer those 9 items, remember those 9 items, learn those 9 items, right? These were the only items which were required to be presented in OCI, other comprehensive income. Is that clear? Is that clear? Clear or not clear? Clear? Now, sir, what else in other comprehensive income? Friends, this other comprehensive income is again bifurcated into two parts. Item that will be subsequently reclassified to P&L and item that will not be subsequently reclassified to P&L. What is meant by P&L here? P&L means above profit after tax, which can be used for distribution of dividend. Friends, first of all, I'll explain the meaning of this item. Item that will be subsequently reclassified to P&L means whatever other comprehensive income items are there, right? When those items will be derecognized or disposed of, where the impact will go, whether it will always remain in OCI or from OCI it will be transferred to profit and loss account, right? So I'll take one example here. For example, a company has purchased a fixed asset, okay, a building for rupees 1 lakh. The company has done the revaluation of that building and the revaluation comes out at 1.5 lakh. So 50,000 rupees is my 50,000 rupees is my revaluation surplus, revaluation reserve. It will go to OCI and this OCI has to be shown as a separate reserve and surplus. It has to be shown as a separate reserves and surplus in your financial statement, right? So the value of fixed asset become 1.5. The accounting entry is fixed asset account debit to revaluation reserve account. Okay, this is the accounting entry, right? This is the accounting entry. Now what happened in the next year? This asset on which revaluation surplus was there, this asset was disposed of. This asset was derecognized. This asset was sold out. Now I need to settle this OCI account also. Am I right? अदर कॉम्प्रिहेंसिव इनकम भी मुझे खत्म करना पड़ेगा ना, जिसमें मैंने ओसीआई रिजर्व दिखा रखा है, 50,000 रुपीज का मैंने रिवैल्यूएशन सरप्लस ओसीआई में दिखा रखा है. So standard says that, Ind AS 16 says that This revaluation surplus is an item that will not be subsequently reclassified to P&L. Means at the time of disposal, the OCI will not recognize in P&L. The OCI will directly transfer to retained earning in the balance sheet. Item that will be subsequently reclassified to P&L means balance sheet to P&L. Item that will not be subsequently reclassified to P&L means balance sheet to balance sheet entry. Means whatever revaluation reserve was there in OCI, it will be directly transferred to retained earnings, right? Friends, let me show you the presentation of OCI in the statement of changes in equity in the reserves and surplus. If you see, this is my reserves and surplus, and retained earning, general reserve, these are part of my reserves and surplus. Can you see separately the other section as a other comprehensive income? In the other comprehensive income, these two line items are there, right? So this is a balance sheet number. Let's say tomorrow this item will be derecognized. So either this impact will transfer to P&L, and through P&L it will come in retained earning, or directly this amount will be transferred to retained earning. For example, revaluation surplus, it will always require to be transferred to retained earning directly. It is not routed through P&L, not routed through the upper section of the P&L, right? So this is the meaning of item that will be subsequently reclassified to P&L, item that will not be subsequently reclassified to P&L. So concept of OCI you guys have understood. The line item you guys need to remember. It is given in my PPT as well as in Ind AS 1 study material. This you need to remember. You need to remember what is my item of subsequently reclassified to P&L, what is subsequently not reclassified to P&L. The concept is item which comes under the category of subsequently reclassified to P&L as per the respective standard. It will, whenever it will be derecognized, it will flow to the part 1 of the P&L, means before profit after tax. And the item which will not be reclassified to P&L, it will go directly to the retained earnings as a balance sheet to balance sheet entry. So this is what which is given for the statement of profit and loss account. Friends, if you have any question, please ask me relating to the profit and loss account. Friend, we have discussed the P&L, we have discussed the profit after tax, and other comprehensive is equal to total comprehensive income. We have discussed the expense has to be classified on the basis of nature. We have discussed the minimum line item on the face of the profit and loss. We have discussed that no item of extraordinary as well as prior period items, right? We have discussed these aspects. Okay. Friends, now there is a question. Your company has a revenue of rupees 100 crores, net profit of rupees 15 crores, and finance cost of rupees 1,45,000. Would you present the finance cost as a separate line item? Would you present the finance cost as a separate line item? Yes or no? Of course, yes, it is a mandatory line item which is required to be shown in the face of the P&L. Would your answer be different if the finance cost were appearing for the first time? In the last year, there was no finance cost, but this year the finance cost came? No, it is still required to be disclosed. Structure and content of OCI, other comprehensive income item, as I explained you, that you need to remember these items, right? You will be able to understand about these items when you read the respective standards, right? So you need to learn these items. Coming to the statement of changes in equity, friends, it's a very simple thing. A statement of changes in equity is nothing. It's a kind of a movement in your equity share capital and movement in your reserves and surplus. Let me show you practically here. If you see, this is a statement of changes in equity of a large listed company, Hindustan Aeronautics Limited. And this balance sheet is for 31st March 2022. So current year is 31st March 22, previous year is 31st March 21, right? So Sumit, there are 9 items which is there in other comprehensive income, right? And all those 9 items, if you see those 9 items, let's say, let me show you that 9 items first. And why I am not going one by one, right? In Ind AS 1, I have to teach the presentation. Okay. If you see, the first part is changes in revaluation surplus. And this will cover under Ind AS 16 and Ind AS 38. The second part is remeasurement of the defined benefit plan. This is covered as per Ind AS 19. The third one is gains and losses in investment in equity as per Ind AS 109. The fourth item is also 109. The fifth item is consolidation related item, which is Ind AS 28. If I start talking about the accounting treatment of these items, it means I am teaching you Ind AS 16, 38, 19, 109, 28 today. And of course, in the next 3-4 hours, even in the next 3-4 hours, I'll not be able to complete this, because this is in a way getting completed while discussing these concept, these standards. In Ind AS 1, presentation of financial statement, balance sheet is a component, and balance sheet covers everything. But I have not teach you everything. Right? Right. Why? You will get to know I have taught you only the presentation, the background behind the presentation. What is the presentation? What is the requirement? Because let's say financial assets are there. So financial assets are coming from financial instruments. And you will have around 8 to 10 classes on financial instruments. Right? I believe now you have understood. Yes. Let's discuss the statement of changes in equity frame. So statement of changes in equity is nothing. It's a movement in equity share capital and reserves and surplus, right? Like what is opening balance? What is changes in equity share capital? What is my restated balance? If there is an error, if there is any prior period error, so this error is required to be shown separately in share capital or in reserves and surplus, right? So if there is any movement, it is required to be shown. Likewise, for other equity, you can see opening balance, changes, which is movement. For example, in retained earning, opening balance is there, add profit during the year is there, then less dividend should be there, and closing balance is there. This is what we always doing in our notes to account. So statement of changes in equity is nothing. It's a movement in share capital and movement in reserves and surplus, movement in other equity. Right? Is it clear? Do you need to tell me something else? Statement of cash flows. Ind AS 1 says that when you talk about statement of cash flow, Ind AS 1 says that, sorry, I'm not dealing with statement of cash flows. Ind AS 1 simple says that please refer Ind AS 7 for statement of cash. This is what Ind AS 1 says. Okay. Ind AS 1 says that please refer Ind AS 7 for statement of cash flows. Right? For statement of cash flows. Now let's come to the last component, which is structure and content of the notes to accounts. Friends, standard says that the notes shall present information about the basis of preparation of the financial statement and the specific accounting policies. Right? Have you seen the specific accounting policies? You must have seen that in financial statement there is a significant accounting policies. You must have seen that. The companies are required to provide the basis of preparation. The financial statement have been prepared as per the Indian accounting standard, as per the historical cost convention, whatever is there here. Yes, the company is providing those things. Okay, is that clear? Yeah, I hope it is clear to all of you. The accounting policy, significant accounting policy, basis of preparation, disclose the information. It says that disclose the information required by Ind AS that is not presented elsewhere in the financial statement. Friends, can you tell me quickly what are the information which is required to be disclosed by a specific Indian accounting standard, a specific accounting standard, and that information was not disclosed in any other component of the financial statement like P&L, balance sheet, cash flow, statement of changes in equity? What could be those information? So let me see if any students have replied. Prakash is saying, sir, related party disclosure. Great, Prakash. Absolutely wonderful. Yes. So, Sumit is saying contingent liability, right? Ind AS 37 requires to be disclose the contingent liability. Ind AS 24 requires disclosure of related party. Capital commitment. Segment reporting. How you guys have forgot segment reporting? AS 17. So now it is Ind AS 108, right? Actuarial valuation related disclosures. Right? So friends, Ind AS 1 says that, see, Ind AS 1 does not segment reporting, related party disclosure. You will cover when you come to the respective standard. Events occurring after reporting date. Great, great, Viraj. Right? So it says that you have to disclose all this information which is required by Ind AS, but it has not presented anywhere else in the financial statement. Right? And it says that you have to provide information which is not presented elsewhere in the financial statement, but is relevant to an understanding of any of them. For example, when you see the balance sheet, you will find only property, plant, and equipment. But when you go to the schedule, notes to accounts, you will find gross block, accumulated depreciation, net block. You will find the class of asset, property, plant, and equipment. You will find plant and equipment. You will find furniture and fixtures, building, land, aircraft, right? Or in case of borrowing, you will find what is the term of the borrowing. It is secured, is it unsecured, what is the rate of interest. You will get all those information in the notes to account, which is relevant for the understanding of the user of the financial system. Standard says that you have to arrange your notes in a sequence. Sumit has also given an example, sir, property in litigation. Yes, Sumit, you are right. Standard says that while preparing your notes to accounts, you have to give a statement of compliance with Ind AS. You remember I have shown you statement of compliance. It says that you have to give summary of material accounting policy. Friends, now the word has been changed from significant accounting policies to material accounting policies. You have to give the material accounting policies, right? Then you have to give the supporting information item presented in the financial statement in the same sequence. Your balance sheet related notes, your P&L related notes, breakups, schedule, you have to give. Then other disclosure like related party, contingent liability, capital commitment, segment reporting, etc., etc. Is that clear? Is that clear? Any doubt, friends? This is a fundamental kind of a standard, theoretical and as well as greatly practical, right? There is no numerical questions as such in this aspect, but yes, on the concepts there are questions. So please do all the questions of study material. If you apply the concepts, if you remember the examples which I have given you during the course of my session, you will be able to crack all the questions whatever is given in your study material or in your revision test papers, right? But you have to very well aware about the fundamental. Friends, then this standard talks about the critical management judgments and estimates. Friends, the standard says that in your balance sheet, the balance sheet is not always accurate. The balance sheet is a mix of accuracy plus best estimate. Like your provision for gratuity, is it an accurate number? It is a best estimate. Provision for leave encashment, asset retirement obligation, depreciation, whether depreciation is an accurate number, it is a best estimate. You have purchased a building, you are depreciating your building over a period of 50 years. Are you saying that after 50 years this building is no more? This building could survive for, let's say, 70, 80 years. This building could fail in 40 years. So it means the useful life which you are taking as an estimate, it's a best estimate. It's a best estimate, right? So friends, in our old accounting standard, there was no requirement of presenting the judgment and estimates. But in Ind AS, in addition to accounting policies, you are required to present your judgment and estimates as well, right? Judgments and estimates as well, in addition to the accounting policy. So let me show you. For example, in this annual report, you will find this company has given the judgment and estimate. For example, for employee benefit plan, for provision and contingencies, from income tax, for income taxes, right? Then the company has started giving the accounting policies. Okay, is that clear? So Indian presentation for India's financial statement, we have division 2 to schedule 3, which is known as India's compliance schedule 3. We have discussed day before yesterday in the first part, right? Then friends, quickly I'll cover the comparison between India's and accounting standard. It's in India's, the guidance is India's 1, and in accounting standard, it was AS1, very small standard, right? In accounting standard, in IGAP, statement of changes in equity was not required to be shown as a separate component. Although the movement in equity, share capital, and reserves and surplus was required to be disclosed in the notes to accounts. But in Ind AS, this component is separately required. Other comprehensive income concept was not there in IGAP, but this concept was there in other comprehensive. In Ind AS, extraordinary item was required to be disclosed as a separate line item in IGAP. This concept is prohibited in Ind AS. A statement of compliance was not required in IGAP. This is specifically a requirement in Ind AS. Judgment and estimate was not required to be disclosed in IGAP. This is a specific requirement in Ind AS. Third balance sheet. Whenever there is a change in accounting policy and whenever there is a correction of error, so third balance sheet was not required in IGAP. It is required in Ind AS. In IGAP, the retrospective calculation was there, but prospective application was there. In Ind AS, the retrospective calculation as well as retrospective application was there. Okay, is that clear? Yeah, friends, this is what Ind AS 1 was there from the entire concept perspective. If you have any question, so Viraj is saying, sir, prior period item in IGAP but not in Ind AS. You are right, Viraj. You are right. So Viraj, the concept in IGAP was whatever prior period item was there, you have to disclose those prior period item as a part of, as a separate line item of the. You have to take the impact and you have to show the impact, complete impact in the current year. But in Ind AS, the requirement is retrospective restatement, third balance sheet, reconciliation, and disclosures, which I've shown you in the last class, right? Let me see if any question is there. Let me see if any question is there. Now, students, I would request all of you, please unmute yourself and ask question one by one if you have any query.
Hello, sir.
Yes.
Yes, sir. Sir, my question is related to current liability. The second point, which is it holds the liability primarily for the purpose of trading. So, will you please give some examples?
Yes. So, Sumit, I believe you are Sumit, right?
Yes, yes, sir.
Yeah. So, Sumit, the classic example is, many times a company, let's say the company has issued debentures. Okay. So,
Okay.
when the company has issued debentures and the debentures are listed. Okay. So, debentures are the liability for the company when the company has issued the debentures, right?
Yes, sir.
It is a liability, it is a non-current liability. And when the company is using, and of course, it's a listed kind of a debentures. So the companies are using those debentures for the purpose of trading. The company is selling those debentures. Or the another example could be derivative liability. Right? The company is trading on the derivative liability. Sometimes the company is selling, their like trade receivables, trade payables. So when the company is trading into their liability, right, it will be considered as a current liability. So if there is a market tradable instruments and the company is trading on into those instruments, it will be considered as a current liability.
Okay, okay, sir. Understood. Actually, I thought about the normal trading. That's why.
No,
Okay.
no. Full form of statement of changes in equity. So SOCIE full form is statement of changes in equity. Equity means equity share capital plus reserves and surplus plus OCI. Any other question, friends?
Sir, in other comprehensive income, there are total 9 items. So, will you please only explain that out of 9 items, what are the items which are reclassified, which can be reclassified into PL and which cannot be reclassified into PL? So, only those examples I just need to note down.
See, this is there in your study material as well as this is there in your presentation also. I believe my presentation is visible.
Yes, sir.
Yeah. So you can see there are 5 examples of items which are reclassified to P&L. Sorry, items that will not be reclassified to P&L. Can you see these 5 examples? Like change revaluation surplus.
Okay. Yes.
For example, if you are revaluing your fixed assets or intangible assets, whatever revaluation surplus is there, this is an item which will not be reclassified to P&L, right?
Okay. Okay.
Remeasurement of defined benefit plan. For example, if you have doing an actuarial valuation for graduate, and whenever you are doing an actuarial valuation, either actuarial gain or loss will come, right? So when you read Ind AS 19, it says that actuarial gains and losses will go to other comprehensive income, right? So this is a second example. So whenever you will read those standard, you will find that the standard talks about taking the impact into other comprehensive income. And Ind AS 1, Ind AS 1 has classified that these items has to be shown as other comprehensive income, either as a reclassified to P&L or not as a reclassified to P&L, right? So Viraj has asked, sir, can OCI be utilized for issuing bonus share? Viraj, other comprehensive income is kind of a reserve, which is not used for issuing bonus share, which is not used for paying dividend. Yeah, any other question, friend? Any other question?
Sir, I have a question, sir. So the question is on other comprehensive income, sir. So when we are declaring dividend to shareholders, so since it is a change in the equity position of shareholders, will that be shown under OCI, sir?
No, madam. So I think you are Bindu, right?
Yes, sir.
So Bindu, what happens? You remember the conceptual framework where income and expenses are defined. If you see the definition of income or definition of expenses, so it talks about what is income. Income is increase in net assets due to a transaction which is happening with a party other than the shareholders, right? First of all, this transaction is happening with a shareholder, right? When you are paying dividend, it is a transaction with shareholder.
Yes.
Whenever there is a transaction with shareholder, it will never come as an income and expense. It means from the jurisdiction perspective. So बिंदु सबसे पहले हम बात करते हैं इसका jurisdiction क्या होगा, इसकी territory क्या होगी. So if it is not an income, not an expense, it will never come to P&L.
Yes,
right?
sir.
If
Sir,
it will never come to P&L, it will never come to OCI.
no, sir, sorry, sir. The question was whether it would be reflected in statement of changes in equity.
Yes. Then it will be reflected in statement of changes in equity directly.
Okay, sir. Thank you, sir. Yes.
Yes. Any other question, friends? Any other question? Someone was asking about a question on applicability of Ind AS. So please let me know if that student is there. Abhishek Sharma. Abhishek has asked, I am reading his question. He has asked, sir, on applicability of Ind AS, I want to ask as cutoff date for breaching the limit of net worth greater than 500 crore or 250 crore as the case may be. Shall we have to consider 31st March 2014 or 31st March 2015? Because Ind AS voluntary came from 1st April 2015. I need your guidance. Please explain with example taking limit based on 31st March 14, 15 and 16. So Abhishek, first of all, I want to clarify when these Ind AS were notified way back in 2015, right? At that point of time, the notification says that you have to see the net worth on 31st March 2014, right? Let's say there was a company and the company has crossed net worth of rupees 500 crore on 31st March 2014. Okay. At that point of time, the company was having an option that either the company can go for the voluntary adoption of Ind AS from financial year 15-16 or mandatory adoption of Ind AS from financial year 16-17. 31st March 2014 पे जैसे ही आपकी नेटवर्थ क्रॉस हुई 500 करोड़, आपके पास मैंडेटरी एप्लीकेबिलिटी आ गई फाइनेंशियल ईयर 16-17 से, राइट? फॉर एग्जांपल ऑन 31st March 2014 the net worth was increased not by 500 crores but by 250 crores. In that case, the mandatory applicability came from financial year 17-18, right? So that was the older scenario. Now, since it's been 8 years when Ind AS came, so if I talk about today, sir, what is today position? So today's position is you have to see the latest balance sheet. What is my latest balance sheet as of now? 31st March 2024. And today there was no limit of 500 crores. Today either it is a listed company or it is an unlisted company. For listed company, listing criteria. For unlisted company, net worth criteria. And net worth criteria is only 250 crores. So if net worth has crossed 250 crores on 31st March 2024, then Ind AS will be applicable from 24-25. This is the applicability criteria of Ind AS on the Indian companies, right? I believe, Abhishek, you are clear now. Any question, friends and students? I'm happy that you are asking questions, right? And you are asking good questions as well. Any other question?
Sir, is there any upper limit for normal operating cycle? Upper limit, like
No.
Okay.
There is no upper limit. There is no upper limit. There is no lower limit.
Okay.
Any other question? Any other question from Schedule 3? Any other questions from any component of financial statement, be it balance sheet, statement of profit and loss, statement of changes in equity, statement of cash flows will be covered under Ind AS 7, right? One says that please don't come to me for cash flow statement. It says that it is my brother who is Ind AS 7 who will tell you the items, components, the concepts of statement of cash flow. Notes to accounts, the standard says that this should be the hierarchy, this should be the order, and this is what which is required to be presented, right? And I've explained this with a lot of examples and the real life listed company annual report. Any question on those aspects? Any question?
So there is one question. So it is a very simple or a silly question, but I
No.
went wrong. I went wrong when I was answering your, you asked an example on operating cycle. So in that question, the 15 months was the operating cycle, whether it should be classified as current or non-current. So I give the answer as non-current, sir. But you said the answer is current. So I would like to understand it correctly if my understanding is wrong. So kindly helps. So if then operating cycle is more than 12 months, means if it is more than 12 months, in the case it was 15 months, will that be taken as our operating cycle?
See, Bindu, what happens? There are two criteria for classification as current and non-current, right? One criteria is 12 months, as simple as that. And if I talk practically, 95% or more than 90% of the company in India, they are taking this cycle as a 12 months. So this 12-month criteria is there. So if any item which is going to be realized or any item which is going to be settled within a period of 12 months from the reporting period is current. Beyond that is non-current. But there are some companies, like if I talk about construction companies, if I talk about sugar industries, if I talk about aviation companies, aircraft manufacturing companies. So they have a long gestation period, right? They have, for example, if a company is manufacturing aircraft, it will take it will take 3-4 years to deliver that aircraft. It will take 2 years to deliver that aircraft, right? So if it is a kind of a company where the operating cycle is more than 1 year, right? Operating cycle could be 18 months, could be 24 months, could be 36 months, right? And you remember I have taken one example that operating cycle means a cycle where cash will be converted into cash, right? Today you are spending money, in your raw material. Your raw material will be processed, become a finished goods, then it will be sold out, then money will be collected. So generally you will be able to, when you spend money and you get money. So generally, if let's say the cycle is 15 months, then 15 months will be your operating cycle, and any item which is realized within 15 months will be classified as current. Beyond 15 months will be classified as non-current. So this 12-month period will be replaced by 15-month period for the purpose of current and non-current classification.
Okay. Thank you, sir. Thank you.
So Prerna is asking one question on the applicability again. Looking on only holding company and fellow subsidiary, when Ind AS is mandatory on holding, and why not mandatory on fellow subsidiary with voluntary applicability is there? So Prerna, first of all, let me explain the structure. There is a company which is a parent company or holding company, and then there is a subsidiaries. There are subsidiaries. Okay. So fellow subsidiary is, let's say A Limited is a parent company and A Limited has two subsidiaries, B Limited and C Limited, right? So B and C both are subsidiary for A. But if I'll ask the relationship between B and C, they are sibling. You understand sibling? Yeah, brother, sister. So these are sibling. Sibling means these are fellows. These are fellow subsidiaries. So if someone will ask that to B, who is C? B will say C is my fellow subsidiary. Someone will ask C, who is B? So C will say B is my fellow subsidiary. So first of all, let me clarify that the concept of fellow subsidiary does not exist with holding. It exists with the subsidiaries. Okay. In my example, A is a holding company, B is a subsidiary company, C is a subsidiary company of A Limited, and B and C are fellow subsidiaries. So in this example, on B, if Ind AS is applicable on A Limited, it is automatically applicable to B and C Limited also. Right? I hope it is clear now.
Sir, in somewhere in study material, there is other disclosure. So would you please light into it, other disclosures of dividend proposed or declared?
Yes. So basically what it says that, you remember when I was talking about the notes to accounts, you remember that portion when I was saying that any information which is relevant, for the user of the financial statement, those information is required to be disclosed.
Yes, yes, sir.
Right? Talked
Yes.
about any information, not only dividend. Someone has declared dividend. It is important information which is required to be disclosed. There could be, if someone is doing a business combination, again this is kind of information which is required to be disclosed. Okay. So standard talks about other disclosure. What could be there in other disclosure? You have to give all those sort of disclosure which is relevant for the understanding of the user of the financial statement. Right? It could be anything. It could be anything from the company perspective, or let's say the company changing its business model. Right? It is again required to be disclosed.
Okay.
Right? Any other question? Any other question, friends?
Hi, morning, sir. I have a question regarding the schedule on the website, actually.
In that case, probably my colleague Shilpa Agarwal ji from Board of Studies will answer to this question.
Yeah, please.
But
What's your query? Thank you, sir. Yeah.
Actually, on the website now, there are like multiple line items. I don't know whether it's a technical error or what is it, but it's really difficult to navigate between the classes and check the schedule.
Actually, what happened, we have uploaded the recorded lectures of the previous batch, because this time, as told in the previous sessions also, that we are going with a hybrid mode. Some of the lectures will be live and some of the lectures will be recorded lectures will be uploaded. So we have uploaded all the recorded lectures on same day. That's why the whole list, and that has automatically be fetched in the schedule also. That is the reason we are trying to improve we are trying to modify the app, because whatever we have uploaded as a recorded lecture, na, that has automatically come to the schedule also. That was not intended, but there is some technical glitch. We are working on that. So just go through the date. Just click that date wala column, and from there you can navigate for next session. Right now, you please do it in this manner. We are working on the app, how to modify it and to
Okay, ma'am. No
include
issue.
only the schedules. Okay, 1 or 2 days we'll do that. Okay.
Thanks.
Any other query?
Ma'am, it will be better if the Zoom link can be like we have to type it, or after that we can arrive here. If it will be better if the Zoom link is provided separately, so that we can click on the link and it will directly.
Schedule in the schedule na, if we go to institute's website na, where the schedule has been given, in that schedule Zoom link is also mentioned there. You can do it.
But it's ma'am, Sumit is right. We can't copy that link. We have to manually type the link.
Okay, we'll do one. We have noted this. We'll do that. Okay, we'll see what we can do in that. We have noted your point. We'll see what we can do on that.
Okay, thank you. Sir, my question is to Alok sir, that sir, in the study material, sir, there is a one item which is total comprehensive income. And so, sir, would you please light about it, that why it is using total comprehensive income, and what is the meaning of it?
Sure. So I have already covered this aspect while teaching you PNL. So I'm again sharing my Excel file. I hope my Excel file is visible now.
Yes, sir. Yes, sir.
If you see, in our old version of PNL, it was only profit after tax, right? Our PNL stopped there. In our IGAP PNL, so this profit after tax goes to retained earnings, right? But now we have another section called other comprehensive income. This total of other comprehensive income will come, right? The total of profit after tax will come. Then there is another line item which is profit after tax plus OCI, which is called as total comprehensive income. And you remember I told you that earnings per share is not calculated on total comprehensive income. It is calculated on profit after tax only. So the total of profit after tax plus other comprehensive income is known as a total comprehensive income. This is the last line of the profit and loss, Ind AS profit and loss.
Okay, okay, sir. Okay, sir. Understood, sir. Thank you, sir.
Any other question?
Sir, can you please discuss like chapter 1 illustration 6 once, because it is not mandatorily applicable on fellow subsidiary over there in this.
It is not mandatory applicable on
Fellow subsidiary. It is applicable mandatory on holding, but it is voluntarily on fellow subsidiary. Can you please discuss that question once?
See what happens, Prerna. First of all, the guidance or notification talks about the mandatory applicability on holding company, subsidiary company, associate company, and joint venture company, right? So what happens? Let's say there is a parent company A Limited and there is another parent company B Limited. Okay. So these two parent companies are sibling, for example, these two parent companies, right? So on one company, and this A and B Limited are related to themselves. How they are become related to themselves? For example, there is a single promoter. There is a single promoter at that promote, and that promoter has invested in both these companies. I have a 80% stake in A Limited and I have a 75% stake in B Limited. So A and B is my subsidiaries, right? And I am a promoter. A and B are considered as a fellow subsidiary for themselves, right? Now A
Yes,
Limited net worth is more than 250 crore. B Limited net worth is less than 250 crore. Is that right?
yes,
So if A Limited net worth is more than 250 crore, Ind AS will be automatically applicable to all its subsidiaries, right? Because it is applicable to
okay,
hold. But let's say B Limited net worth is less than 250 crore, Ind AS is not applicable to B, right? And there are subsidiaries
right,
of B also. There are subsidiaries of B also. Okay. So there are subsidiaries of A Limited. There are subsidiaries of B Limited. So the subsidiaries of both these companies are known as fellow subsidiaries. Okay. But Ind AS is applicable to subsidiary of A Limited. And Ind AS is not applicable to subsidiary of B Limited. So standard says that, or not standard, guidance says that in case of subsidiary of A Limited, Ind AS is mandatory applicable. But Ind AS is not applicable to fellow subsidiaries of A Limited. Are you getting me? So these subsidiaries of B Limited, who are the fellow subsidiaries of A Limited, so these fellow subsidiaries can apply voluntarily. Mandatory, it is not applicable to them. This is what the notification says, and this is how that illustration was drafted and solution was given. Is that clear?
yes. Because A limit one company A Ind AS is mandatorily applicable, so the holding is also need to apply Ind AS, but a fellow subsidiary can apply voluntarily.
Yes.
Actually, Prerna, here you have to understand the concept of fellow. The meaning of fellow, I think you are getting confused by fellow means downward. It's not downward, it is parallel when they are related. What sir is trying to explain is that they are not, they are only related, but they are not direct subsidiaries. They are subsidiaries of one promoter, so they are called as fellow subsidiaries. The concept of fellow you have to understand to appreciate that particular illustration.
Right. Okay, ma'am. Thank you.
Any other question, students? Students, I have covered all the questions on the query box as well as on this chat box. So I think nothing has been left to answer as of now. If you have
One
any question,
question, one student has mentioned notes for recorded lectures are not available. Previous batch assignments, you have done that? We have done previous batch assignments are there. We'll just check it out twice, and in case it is something is left out, we'll see that also. We have noted this point. However, from our side, we have when we have uploaded the recorded lectures, there you'll find in your BOS mobile app or in the BOS knowledge portal, where after login that there's a notes and assignments for current batch for previous batch also. So from there you can take out the notes of the recorded lectures. In case something is missing, you just let us know. We'll do it. We'll see on this also. Okay, Chandan? Anything else, students? Otherwise, we'll wind up the session.
Sir, I have a last question that if company A is the holding company of B and Ind AS is applicable to company A, then the Ind AS will be applicable to company B automatically. So if there is a subsidiary of company B, suppose company C, which is a subsidiary of company B, so is Ind AS will be applicable to that subsidiary also?
subsidiaries include step subsidiaries also.
Okay. Okay, so thank you.
Thank you, students, and thank you for this, just listening on a very patient basis. So, and asking so many important questions. So, even I have enjoyed the session thoroughly. Thank you so much. And so I'm logging off and I'm concluding the session. Thank you so much. Have a great day.
Thank you, students. Thank you, sir.